Over the past 2 years, gold has risen by 30%. But do you know how much Bitcoin has gone up? 350%, and the biggest buyers aren't retail investors, they're nations. In my previous video, we talked about how the BRICS countries are trying to break free from US dollar dominance by building cross-border payment systems, discussing a common currency, and pushing for more local currency trade, all attempts to rewrite the rules within the existing system. But system reform is easier said than done. It requires multi-country consensus, alignment of geopolitical interests, and even facing US pressure head-on. So if changing the system isn't realistic, is it possible to simply step outside of it altogether? In today's video, we'll discuss, is Bitcoin the real de-dollarization path beyond BRICS? Since the Russia-Ukraine war broke out, the US dollar has officially turned into a financial weapon, sanctioning banks, cutting off SWIFT access, and freezing central bank reserves. For some countries, the biggest risk isn't losing money, it's not being able to move it at all. So, certain nations started looking for an alternative route. Russia has reportedly used USDT or Bitcoin to settle energy trades. El Salvador made Bitcoin legal tender and continues adding it to national reserves. Iran openly stated it would use blockchain assets for imports and exports. According to Reuters, since 2022, Iran has imported multiple shipments worth tens of millions of dollars, settled directly in cryptocurrency. Meanwhile, Russia's deputy finance minister publicly said they don't rule out using Bitcoin for cross-border trade, especially between sanctioned nations. For these countries, Bitcoin is no longer just a speculative tool, it's a backup channel for moving assets under systemic risk. You might ask, but isn't stablecoins the mainstream choice since so many nations use it? True, stablecoins like USDT and USDC are widely used. They're stable, dollar-pegged, and liquid. But stablecoins don't equal freedom. They're issued by companies that can freeze assets, blacklist addresses, comply with government sanctions. For example, in 2022, Tether cooperated with USOFAC requests and froze over 160 addresses, holding hundreds of millions of dollars, including some users who were never tried in court. Even if it's on the blockchain, your money still isn't fully under your control. Bitcoin, on the other hand, has no central authority, has no issuer, cannot be frozen. It is the only truly decentralized, censorship-resistant asset on-chain. In short, stablecoins are the dollar's digital extension, while Bitcoin is money outside the system. Even if the US tries to regulate stablecoins, they can't completely seal the exit. As long as USDT can be swapped for Bitcoin, capital can move into a parallel, blockchain-based system. You can swap USDT for BTC, transfer it to any decentralized wallet, move it without banks, approvals, or freezes. Even if they block the entry points, the exit is already there. This is why, despite stablecoins being mainstream, Bitcoin, however, is the only asset that truly sits outside of the system. It has no issuer, no freeze risk, no borders, and a fixed supply. In many ways, you could think of it as gold for the digital world, the on-chain gold of our era. Bitcoin's maximum supply is capped at 21 million, and over 90% has already been mined, with more than half locked in long-term wallets, making its circulating supply even scarcer. But ultimately, physical gold versus on-chain gold, which is better? Performance, risk, portability, hedge potential? In the next video, we'll put Bitcoin head-to-head with gold to see which one is the real hedge in the modern era.